Whether it's from your social media feed and influencers, your colleagues, or that slightly uncomfortable Thanksgiving dinner talk with your uncle, you're going to hear a lot of advice throughout your life on how to manage your money. And while some of those pieces of advice are well-intentioned, the truth is that financial strategy isn't one size fits all. Applying those same common sense rules you used when you were making $100,000 to now when you're earning $500,000 can end up costing you a lot of money in the long run. In this video, we're going to go over common rules you've probably heard, why they work for a median income, and how to adjust them as your salary increases. Because the biggest thing there is to know about rules is that you need to learn when to break them. Rule number one is the 50-30-20 rule. This rule is where you break your spending into three buckets: necessity spending, spending on wants, and investing/debt. So why does this work for people even up to the low six figures of income? Well, like most rules of thumb, this works well within situations that are pretty normal. So let's say we've got a guy named Joe. Joe works in cybersecurity in Ontario and earns $120,000 a year. So Joe's going to head over to our website. He goes to the cash flow calculator section, plugs his numbers in, and his after-tax income comes exactly to $86,668. That's what he has to work with. And so if we apply the 50-30-20 rule here, that means he should allocate about $42,500 a year on necessities, $25,500 a year on wants, and $17,000 a year on paying down debt or investing. And those numbers make a lot of sense. Like if we look at the Statistics Canada data from 2023 to 2026, we'll see that a single person living in the city of Toronto with an average lifestyle should expect to spend right around $41,000 a year on necessities, including rent, groceries, utilities, and public transit. So despite Toronto being a actually very expensive city to live in, an average lifestyle still fits within his budget and giving him a pretty comfortable living position. Also, he's got about $25,000 a year in disposable income. This is a pretty reasonable amount to work with. So let's look at the investing pool. According to the Bank of Canada, inflation has averaged about 2 to 3% a year. So we're going to assume Joe's salary rises accordingly. Meaning, if Joe diligently saved that $17,000 a year and invested the money, earning a reasonable 6% return every year, he would have just over $1 million after 25 years. That plus CPP and old age security would allow him to retire and live a similar lifestyle to the one he's accustomed to today, even after adjusting for inflation. However, as I said, this rule does not work well with high income earners, and here's why. The rule is designed around the limitations that come with a lower salary, as well as the fact that it simply costs money to survive. If you want 3 square meals a day, it's going to cost a certain amount of money. If you want a roof over your head, that costs money too. And for a lot of people, that 50% allocation towards needs is simply what it costs to survive. Even as your income increases to that 6-figure milestone, often that just takes you from surviving to living comfortably. Of course, it depends on what city you live in, but look back at our example. At $120,000 a year salary, this gives Joe the average standard of living in the most expensive city in all of Canada. Let's say Joe recently completed his master's in computer science and made the jump to the private sector where his income jumped to $500,000 a year. This has actually happened with a client of ours. After taxes, that's now $136,000 fitting into just his needs category. So does he suddenly need to go find a house that's like 3 times more expensive than the average home? Does he need to start buying all organic food so his grocery bill triples? Should he leave the faucet running and the refrigerator door open just so that he can get his utilities bill up? Of course not. At $500,000 a year, Joe has reached a position where he is no longer required to spend half of his income on basic necessities just to survive or be comfortable. Now, Joe has options. Options to shift some of those funds into his wants category and spend them on things like clothing, restaurants, or entertainment. Or he could shift some of it into paying off debts early or increasing his investments. Let's take a quick glance back at that rule. Why is it 20% for investing? Well, because just like you saw in our example, that tends to be about how the math works out to maintain your current lifestyle into retirement. And I said maintain, not to improve your lifestyle and not to open up options like retiring early or making big and risky career changes down the line. Now let's look at the numbers again. With his new $500,000 a year salary, that 20% allocation is now $55,000 a year after taxes. And after investing that for 25 years, that would grow to about $2.9 million, which is certainly not anything to scoff at. But for someone who's making $500,000 a year for a quarter of a century, that's actually kind of an underwhelming number to retire on, especially when you think about how much money he probably left on the table. So what should Joe actually do? He's now realized that as a high income earner, he should probably stop following a rule that was never designed for creating wealthy people. But what comes next for him? Okay, well, for starters, the biggest thing people get wrong with this rule is that they don't adjust it with their income and complexity. This is where I would sit down with Joe and map out a complete cash flow plan. What does his income actually look like? Is it all salary? Is some of it a bonus that can vary from year to year? Is some of it stock options in the company? Next, we'll look at his long-term goals. Does he want to get married, have kids, and save up for his kids' college tuition? Does he want a retirement home in Florida and possibly a cottage up in Muskoka? Does he want to give himself the option of an early retirement, or perhaps the peace of mind and security to simply know he will never have to worry about money ever again? Importantly here as well, what are the timelines for these goals? If this is starting to sound complicated to plan, it certainly can be, but when you've worked your way to an income level that grants you these options, you shouldn't be settling for like a one-size-fits-all approach like the 50-30-20 rule. Everyone's situation is different, with different goals and income cadence, which is why it's often an excellent idea to hire a financial planner to help you through this process. At this point, they'll probably save you a lot more money than they cost. Or you can check out this video here, 12 years of brutally honest financial advice, where I spoke about the exact method of how to construct cash flow plans. But let's say in the case of Joe, his goals are to buy a retirement home in Florida, a cottage in Muskoka, and not have to worry about money when he retires. So we determined that Joe needs a little bit more than $3 million for his retirement goals. So what we did was we set him up on a plan that has him upgrading his middle-class residence to something a little bit nicer and spending around $8,000 a month on needs, spending $4,000 a month on wants. He really wanted a Tesla, and then investing the remaining $128,000 a year. That $128,000 a year turns into $7.02 million over 25 years. And in Joe's case, we basically reversed the 50-30-20 rule and had him spending roughly 30% on needs, 20% on wants, and 50% on investing. And obviously your numbers are going to differ, but what's important here is that you come up with a plan that suits your needs specifically and not just rely on some general rule of thumb you heard over the dinner table. Rule number 2 is 100 minus your age. Said another way, your age in bonds. This rule states that you should take your age, subtract it from 100, and the remaining number should be invested in stocks, and your age should be invested in bonds to mitigate risk. This is what is called asset allocation, and it's actually something that's really, really important. In a 1986 study done by Brinson, Hood, and Beebower, they found that asset allocation, which is how you divide your money across stocks, bonds, and cash, explained over 90% of the variability in a portfolio's return over time. In other words, what percentages of your money you put into each category of investment types is the driving factor behind how much your investment will swing up and down and whether you'll actually get good or bad returns. And this has a far greater impact than things like timing the market or even picking individual stocks. Meaning getting asset allocation wrong can have your portfolio seesawing in a direction you are not comfortable with and investing in risky assets that actually do not pay you for taking the risk. Let me show you how this rule works as a general framework, but is not optimized for someone like Joe. Joe and I are the same age, 32 years old. And that means that according to this rule, Joe and I should be investing 68% in stocks and 32% in bonds. Why is that? Well, the idea behind it is that stocks are much riskier and more profitable investment types than bonds are. So stocks make sense when you're younger because you have more time to both take advantage of the higher returns and to wait out the downsides that come with risk. But as you get older, you should gravitate towards bonds since it becomes more important to protect what you've built than it is to try to chase returns. This rule does follow some semblance of logic. It does have a major issue though. It's way too surface level in general. A person could very easily follow this rule but still make very poor investment decisions. And once again, it serves as a one-size-fits-all since it assumes that every single 32-year-old has the exact same risk tolerance, expected retirement age, etc. A one-size-fits-all strategy will always be inferior to one that is specifically tailored towards your personal needs. Let's look at an example. This example that I'm going to use are what I've commonly see investors hold before working with me. So Joe uses the 100 minus your age rule, and he goes out and buys 10 different stocks of companies that are his favorites, a couple famous IPOs of companies he likes, and puts the rest into a fund that tracks the S&P 500. And since he has no clue what a bond fund is or what bonds actually do, he asks Claude what the best bond funds to invest in are and ends up with a junk bond portfolio that did really well in 2024 and 2025. Now Joe has a 68-32 stock to bond portfolio, and Joe followed this rule and thinks he is set. He is not, in fact, set. I've seen this asset allocation or similar ones way too many times from new clients before working with me. Joe has made some very suboptimal decisions simply because he didn't really know any better. He's unfortunately put himself in a position where he only owns US stocks, which have actually underperformed international stocks in 2025 by almost 15%, and invested in a highly risky junk bond ETF in which half the companies are going bankrupt and they're looking for dumb money to show up and buy their debt. Enter Joe. Sorry, Joe, but the truth is kind of hard to hear sometimes. He is at risk of severely underperforming what he should be doing given his age and risk tolerance, and exposed himself to way more risk than he would have if he'd simply bought a 100% stock index fund like VEQT in Canada. What Joe should be doing instead is investing for the maximum return possible given something we call constraints. Constraints are the limits you put on the risk you are willing to take, either due to psychological reasons, tax reasons, or personal reasons. We can determine this by Joe's risk tolerance and risk capacity and a detailed review of his financial situation. So let's say Joe's high risk in terms of his tolerance, and he's got a good income, and he can mentally withstand large swings in his portfolio in order to achieve higher long-term returns, and he also has the capacity to see a 20 to 30% drop in a year without it affecting his lifestyle or the decisions he makes. In this scenario, Joe is actually very well suited to be in 100% stocks. The next problem becomes finding the right mix of stocks to invest in. When Joe and I sat down, I introduced him to the idea that investing had actually been solved. There's 100 years of academic data to prove it. And I walked him through how markets are mostly efficient, how small cap and value consistently outperform the large cap indices, and how diversification into other markets, like international markets and emerging markets, while maintaining a healthy weight to his home country, in this case Canada, makes sense from a tax perspective. This is backed, of course, by the research of Eugene Falma and Kenneth French and their seminal research on factor investing. The portfolio that Joe invested in was a mix of 30% Canadian stocks, 50% US stocks, and 20% international and emerging market stocks. He reduced his risk and sold that crappy bond fund while maintaining exposure to 100% stocks and increased his likelihood of higher long-term returns. This is why asset allocation is so important, but should be taken much more seriously than just X% stocks and Y% bonds. In another video, I'm going to walk through the research on lifetime asset allocation and why data is pointing to maintaining exposure to 100% stocks, even in retirement. Make sure you subscribe to be the first to see it. And lastly, the rule number 3, the 4% rule. Joe's been saving diligently for one major thing. He wants to retire. The problem is he has no idea if he can retire when he wants to, and if he will have enough money to do so when the time comes. Enter the 4% rule. The 4% rule is basically, can you live on 4% of your current investment portfolio or your projected investment portfolio? If 4% of your existing investment portfolio can fund your lifestyle needs, then you're good to retire. So essentially what you would do is you would take your existing portfolio and divide it by 25. If that income number makes sense, you're set. So if I wanted $100,000 of income per year for 30 years of retirement, adjusted to inflation, I would need $2.5 million. So this is a great strategy if you want to give the government a ton of money across retirement, much more than you need to, and not actually have enough to live on. Let me explain. The 4% rule was created by William Bengen in 1994 to determine safe withdrawal rates for retirees. Bengen determined that in order to sustain retirement spending across 30 years, you could safely withdraw 4% of your retirement portfolio and have around $0 left over at the end of the 30 years. It's actually one of the more academically sound rules of the bunch. At least there's historical data to back this up. The problem with the 4% rule is that most people do exactly what I did at the beginning of this section. They set a target amount of, let's say, $2.5 million to spend $100,000 a year and completely ignore 90% of what retirement actually is. From a financial perspective, retirement planning is the ability to stop trading your time for money and being able to do the things you didn't have time to do when you were working. How you do it is a bit more complicated. For Joe, if he follows my advice and has $7 million stashed away at 65, or even $4 million at age 55, he still does not have his retirement mapped out yet. So the first thing you need to do is take tax into consideration, because how you saved that money will make a big difference on what taxes you need to pay in retirement. How much of it is sitting pre-tax, sitting in things like RSPs or a 401k if you're in the States? How much is tax-free, sitting in a tax-free savings account or Roth IRA? What is his monthly income going to look like from pension plans like CPP and Social Security? And yes, I know it's going to run out for you guys in the US, but Canada, we don't have that problem. Another question is how much should be in stocks and how much should be in safer investments or annuities to sustain spending? Solving for taxes and government sources of income is something the 4%ers rarely do, and even Bengen didn't do in his analysis and admitted the tax drag becomes a concern. Remember, he also only looked at retirement over 30 years. If you retire at 55, you may be looking at planning for 40 years or even more as human life expectancy continues to increase year after year. The variables are too high to rely on the 4% rule as your retirement plan. I don't actually mind this one so much as a rule of thumb, but there needs to be a lot more work put into it than simply a one-time calculation and just hoping that it'll all work out. So this brings me to my final point. Rules of thumb should be treated as general guidelines. When variables are introduced, they almost always break. They were created for people who don't have access to financial advice because of income or net worth limitations. But the number one reason why people reach out to me and hire me as their wealth manager is because they used the rules to get to a successful point in life early, and now their situation is way too complex to keep employing them, and they don't want to make mistakes or leave money on the table. At Million Wealth, we make sure they don't. If you want to stop spinning your wheels financially and level up your wealth, click the link in the description to get started.